Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 31st of July. I'm Daniel Lam, your host for the podcast. We spoke in length about the U.S. financial sector in yesterday's podcast. Another sector that we mentioned in a recent series of Trump Trades podcasts was U.S. energy. Now, historically, that sector is, quote-unquote, highly associated with the Republican Party. And policy-wise, it is likely to benefit from any scale back from the U.S. on climate change agreements. But it is a less convincing idea than U.S. financials. While positioning is low across both, U.S. energy sector lacks the confluence of positive drivers for financials that we mentioned in a podcast yesterday. The key capping factor is the weakness in crude oil prices. The drop in July has erased its gains in the month of June. This is going against escalating Middle East tensions and higher Chinese industrial profit growth in June. So if you look at the broad commodity complex, oil prices tend to lag peaks and troughs in the business cycle. On the other hand, industrial metals prices' high exposure to the manufacturing sector makes them a leading economic indicator. Now, industrial metals peaked back in May and have since been underperforming the broad commodity complex. Therefore, oil prices may be catching up to the reality of subdued demand conditions. The OPEC, EIA, and IEA are projecting a moderation in demand this year. None of them are anticipating weak consumption growth by historical standards. Now, on the supply side and aside from Middle East tensions, the latest move in OPEC Plus's production agreement suggests that the group may be lowering its aim from raising prices to defending a price floor. Supply cuts will not begin before October and will only be good enough to offset increased outputs from the non-OPEC Plus producers. The one saving grace, at least in the short term, for crude oil prices is that it looks to be oversold technically, and it may be able to rebound closer back to the $80 per barrel level. Nonetheless, the trend is still not looking so bullish compared to the opportunistic upside that we see in the large-cap U.S. financials. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.